Welcome back to the channel, everyone. Today I wanted to talk to you about whether the hedge funds can escape, whether they can somehow cover all of their shares in the dark pool or on Citadel Connect without impacting the lit exchange price and effectively get away and cover their millions and millions and millions, potentially even billions of shorts, when you include the synthetic shorts, without any repercussions whatsoever. Trust me guys, you do not want to miss this video, so stay tuned and let's make some money. But guys, before I dive into the video, I just want to give a massive shout out to the 1,700 of you that have currently dinged that notification bell, because you guys are always the first to watch a new video as soon as it's released. So guys, be sure to drop a like down below, subscribe to the channel and ding that notification bell so that you don't miss another video just like this one. And now I want to dive straight in with the key information. So, the final lesson. Can hedges cover in the dark pool? Who will pay for the squeeze? When do I sell? How can I make the mother of all short squeezes happen faster? Why is there so much FUD? So to start with, can the hedges cover in the dark pool? I see this question a lot, and I believe part of it comes from a misunderstanding of what the dark pool is and how it functions. Dark pools are temporarily segregated venues where the buyers and sellers are concealed, meaning that the trading occurs off exchange but still eventually hits the ticker that you and I see and trade on. All dark pool trades will reflect in the price. Former Citadel trader turned ape David Lauer made this clear in his recent AMA for Reddit Superstock. So even if a large block purchase was made by shorts of sales within a dark pool, it will hit the ticker after the fact. How long? That's up for debate, considering the discourse that has surrounded order delays and the various mechanisms hedge funds use to suppress or otherwise control the impact of price temporarily. Basically what that means is obviously if some shares fail to deliver, then they technically aren't reported and obviously won't impact on the price because there was a fail to deliver at that time. But when the fail to deliver is resolved and the delivery is made successfully, then it'll impact on the ticker price. Also, there's some speculation as to whether dark pool trades are actually made on a T+31 or a T+35 basis. As in, the transaction that occurred in the dark pool won't actually hit the lit exchange until 31 or 35 days after the fact. We also know about Citadel Connect, where technically they don't even have to report the trades to FINRA, but supposedly Dave Lauer made it clear that even those trades will impact the lit exchange price at some point. Now, that being said, what would be required for Citadel and company to cover within a dark pool? Well, one of two things. A massive block of sales from institutions, or B, a massive block of sales from retail. Now that's how they could cover in the dark pool. Technically, retail traders can't trade directly in the dark pool, but with payment for order flow, brokers like Robinhood or Webull or Charles Schwab or TD Ameritrade are obviously going to be selling their order flow to Citadel that will just pass those transactions through the dark pool. So therefore, even though you and I aren't trading directly in the dark pool, if you are using a platform like Robinhood, it could potentially end up making its way through into the dark pool as part of a block of trades. In both cases, the closing of these positions would ultimately reflect on the ticker after the fact, at some point. So let's talk about that. We can see what institutions are doing via their 13F filings. Yes, there is a delay on these, but to date, no major institution has dumped even the 100 million shares that will be required to close the registered short interest. In fact, some major institutions are still regularly increasing their position, like State Street Corp, which recently increased their AMC position by 6.5 million shares. If you want to see the institutional ownership of AMC for yourself, just go to whalewisdom.com and search for AMC. Then filter for the date reported to see the most recent transactions, and then you can see which institutions are adding to or subtracting from their position. This is also why retail ownership is so fundamentally important in a play like this. We've got 4.1 million investors in AMC as per the last announcement from Adam Aaron, although it's probably more likely more than that by now, at least 5 million plus. If just 50,000 of those 4.1 million or 5 million holders own 10,000 shares, they own the entire float of 500 million shares. If 100,000 AMC holders out there out of the 4.1 or 5 million each own 5,000 shares, they would also own the entire float themselves. If 200,000 AMC holders out there out of the 4.1 million or 5 million holders own 2,500 shares each, they would also own the entire float themselves. If 100,000 people out there owned 5,000 shares each, 500,000 people out there owned 1,000 shares each, and 1 million people out there owned 500 shares each, then we own the AMC float 3 times over, as in we own 1.5 billion out of a 500 million potential share count, even if the remaining 2.5 million shareholders just had 1 share each. Personally, I don't think it's too far-fetched to assume that 100,000 people out there own at least 1,000 shares in AMC. I've seen mega silverbacks owning at least 10,000 shares plus posting on this Reddit forum. So therefore, don't ever question the retail ownership of the AMC float. We own the float, even disregarding the institutional ownership. And overwhelmingly, we're also seeing those clear indications that retail simply is not selling. Whether that be by Fidelity constantly reporting double the number of buy orders than sell orders, or inflow being greater than outflow on any given day, retail is not selling their shares. And as we've also seen in the past with Mudrick and dilutions, retail readily buys up any shares dumped into the market. Basically, they theoretically could cover in the dark pool, but they haven't done that yet. If they did, we would eventually see that impact on the stock price in the lit exchanges. I also get a lot of questions as to whether hedgies can cover their synthetic shorts with synthetic made-up shares. Yes, and they will be. The chances that you, that are reading this right now, or listening to this right now, own a real, live, authentic backed AMC share is little to none. You own synthetic shares. I own synthetic shares. We all own synthetic shares. Synthetic shares act as real shares in the market. There's no way for anyone to know whether they have a synthetic share or one of them OG authorised shares. Hence Felter delivers. Felter delivers can be thought as the vestigial remnants of a share sold or brought which did not have a true point of origin or a true owner. A Felter deliver cannot exist until the share has already been transacted, meaning it's been released into the wild and has a new owner. We as retail traders cannot create or control synthetic shares. Thus, it's not our responsibility to know whether or not our shares are real. As far as we're all concerned, all of the shares we have are real. Now this goes back to float ownership, and it's more important. Once the mother of all short squeezes begins, we, as the only true and authentic owners of these shares, must be the source for a short to purchase their position and close it. Because obviously we can't create or control synthetic shares, therefore our shares default as the real shares, and those hedgies have to buy our shares. As we're all very confident the float is over short, as in a short excess of 100%, that means purchases to cover will not re-enter the float, but rather be eliminated from existence and not return to the float to create liquidity. As in, once the hedgie purchases our share because it's a synthetic share, it just gets cancelled. And then if they need to cover more shares, they just have to buy more synthetic shares and cancel them, rather than selling the synthetic shares back into the market. And that also means that if any paper hands do actually sell their shares, their impact will be minimal. Sales will not even start to tamper the buys until whatever excess has been eliminated. Because even if the paper hands do sell their shares, they're selling synthetic shares which just get cancelled. This is why the potential for losses for shorts in this play is infinite, whereas ours are simply a finite loss. We can only lose the money we put in. They can lose everything and more. If AMC squeezes to XXX price, who pays for it? Is there enough money? I constantly see posts about the DTCC and its so-called insurance. However, I believe there's a slight misunderstanding as to what it is and how it works. There's no $50 trillion or $60 trillion or $30 trillion insurance per se. What there is, however, is an obligation for the defaults to be covered. Let's go to the DTCC themselves and take a look. If, after forcibly closing out and liquidating a default member's position, the NSCC was to suffer a loss, such loss would first be satisfied by the amount on deposit to the clearing fund and eligible clearing fund securities pledged by the defaulting member. If a loss remains after applying the corporate contribution, the NSCC will allocate the remaining loss among members that were members on the first day of the applicable event period. Basically, if a hedge fund defaults and cannot actually afford to buy the shares back, basically the NSCC splits that loss between every single bank and hedge fund across the entire country. In this way, it sort of acts like insurance. You'll pay into protection for your car, but if someone else has an accident, some of the money you pay into your policy will likely be going to help them, and vice versa if you were ever in an accident. The DTCC provides a tremendous amount of services for market makers and major institutions, and members in turn have some obligations to the DTCC. This is one of them. That 50 or 60 or 30 trillion figure that people throw around is technically just the total assets managed by the clearing corporation, as in the total value of all assets of all members of the DTCC. Ultimately, who pays is not your responsibility, nor is it something you should really be worried about. So how can I help make the mother of all short squeezes come faster? It's very much a waiting game, and I know it can be frustrating. While we cannot cause, trigger or predict or otherwise anticipate when the mother of all short squeezes will occur, there is actually a few things you can do as an individual investor to strengthen the mother of all short squeezes thesis, such as switching from brokers that sell their order flow, as in Robinhood, Webull, Charles Schwab, E-Trade, TD Ameritrade, Ally, First Trade and TradeStation. Not participating in any non-mother of all short squeeze events, like the festival that shall not be named. Do your due diligence. Have confidence and secure argument for AMC's squeeze thesis, and spread kindness and knowledge. Be the best example of an AMC holder. Encourage your favourite YouTube personalities to not promote payment for order flow brokers like Webull, which is why I removed the Webull link from the end of my videos. Support AMC. Go to a movie if you can, and contribute to AMC's record-breaking post-pandemic attendance numbers. Buy shares, not options, and finally, directly route your buy orders to the New York Stock Exchange if you have Fidelity. In terms of how do we know when to sell and how we know when the squeeze is over, I don't really want to read too in-depth into that, but effectively, it's your choice to sell whenever you feel comfortable. You'll know when the short squeeze is over, when all of the shorts have covered their shares. What do we do once the squeeze is done? So many people are talking about an economic collapse. How do we protect our money? I'm not a financial advisor, so I can't tell you what to do, but I will share with you some options I'm currently exploring for myself. These include reinvesting of assets into securities that have been known hedges against market deteriorations, reinvesting assets into precious, stable metals such as gold and silver, reinvesting assets into stable currencies such as the Swiss franc, reinvesting assets into tax counters such as artwork, or consider purchasing property rather than renting or leasing it. But there seems to be a lot of FUD going around lately. Do I have to be worried? Not at all. Remember that FUD means fear, uncertainty and doubt. It's information, discourse or attacks intended to make you feel one of those emotions with respect to your position in AMC. I have noticed an uptick in extreme insider fighting, antagonism, drama and overall bad vibes. So if you're feeling the same way, you're not alone. So in turn, spread positivity, be a force for good. AMC holders have nothing but love for each other and every other ape out there. Spread your due diligence, lend out your confidence. Don't hate, educate. And if someone's still hellbent on trying to make you feel bad about your individual investment decision or your future with AMC, laugh it off, shake their hand and move on with your day. And finally, some advice to you, don't be afraid and trust the process. As always guys, if you haven't yet, I'd really consider checking out the Patreon and the private Discord, linked in the description below, where we talk about AMC and other stocks, sharing news, due diligence, and more. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!